Where do you store your cash today? The dollar's lost 95% of its value since it ever came out. It left the gold standard in 1971. Are you happy with the bond portfolio and the volatility when we've seen interest rates increase, putting your principal at risk? What do? Well, I brought in someone that's got a PhD. Do I have to call you doctor? I've never called you doctor.
Please don't.
But you got the PhD in retirement planning.
Yep.
And you wrote a book called Permission to Spend.
I did.
Great book, and your presentation skills are phenomenal. When I heard you speak on this topic, I thought it was fantastic. And you just really made this argument of, hey, look, everyone has some type of fixed income portfolio if they're preparing for retirement. Right. And in that fixed income portfolio, it's a lot of bonds quite often. And when interest rates go up, those bond values are at risk because they could lose, and people will mitigate that with bond ladders where they'll have like different durations of when it matures, and then they, don't take the longer durations if interest rates change. But you had just a solution, and you showed the numbers that people could just allocate towards whole life policy. Now let's dive into that a little bit.
Yeah, I can kind of give you the history on that too. So
yeah.
When I did my dissertation, I wanted to compare whole life insurance versus a bond alternative, or as a bond alternative, because there's been so many advisors that talk about that. And I was just like, does that actually make sense, or is that a good sales pitch? And what was fascinating to me is, as I started to do some of the research on the history of bonds, I realized that, and we kind of knew this, but we are coming off of the biggest bull market in bonds ever. And it was because interest rates fell basically every year since 1982. So what's interesting,
such a long period of low interest rates is crazy.
It's incredible. And as interest rates fall, bond prices go up, and there's been not a lot of volatility. So even in bad years, you still got a little bit of a yield. But that happened during the time when the 401k and the way people save for retirement was really coming into play. I mean, the first bond index, I think, was the Lehman Brothers in 1974. Barclays Aggregate, everybody knows about, 1976. The 401k was invented in 1978. I mean, people weren't investing the way they are today prior to this period of time when bonds could do no wrong. So
it's amazing that I was born in 1978, because it must have been just like, we need someone to speak out against how terrible these 401ks are.
Yeah.
It was born, and so is its adversary. I don't know.
It's true. It's true. And what happened was, the stock bond portfolio, the 60-40 mix or whatever it was, bonds were the perfect diversifier for equities during this whole period of time. And now that's kind of broken. Now we've bounced off the bottom of interest rates, and people are starting to experience what we did in the early 1900s. And just a quick fun fact, bonds lost.
Like when you say what we did, as if you were around.
Yeah, we as Americans, I guess. But during the last 40 years or so, bonds lost value about once out of every 6 years. In the prior 40 years, as interest rates were rising from the 40s into the 70s, bonds lost value about 1 out of 3 years. So going forward, we're in a period of time where I'm not saying don't own bonds, don't diversify, but it's not going to be what it was in the past, and that's not an opinion, that's math. Bonds move based on math, not like Tesla stock where we all just agree it's going to take over the world, so we vote the shares up. Bonds are different. It's just simply a mathematical equation. So yeah, I think a lot of investors and a lot of clients need to rethink their allocations and give themselves some upward potential in that safe stuff.
Well, let's break it down just a little bit for people that, maybe this sounds a little bit foreign. So when you get a bond, it's a debt instrument. Basically, whether it's a corporation or a government,
yep,
you're lending them your money.
Yeah.
And for borrowing the money, they're paying you an interest rate.
Mm-hmm.
Not that much different than a bank, really.
It's like a CD at the bank, but just on a much bigger scale.
Right. So you got, treasury bills, treasury notes, they're different durations, essentially.
Yeah.
Treasury bonds. Then you've got corporate bonds, other government bonds like municipal bonds. And so these are all debt instruments which have priority if those companies get into trouble. They're going to pay the bondholders before the stockholders, but they're going to declare an interest for you.
Right.
And then your price that you pay, you get that interest. Now, if that interest changes in the market,
right,
it goes up, you're going to have to sell your bond for less because someone else can go buy a new bond with a better interest rate than what you have.
Exactly
it's
right.
that simple. On the other hand, if interest rates go down like they were doing from 1982 on, your bond keeps going up in value because people that go buy the new bonds can't get as good of an interest rate as what you have. And
right.
So it actually drives your price up. So that's just the very simple mathematics of it. But in this environment we're in, that's crazy that 1 in 6 years it ever had a loss, and now it's, it was 1 in 3 before.
Right.
And by the way, this is a big issue that happened with Silicon Valley Bank, is they had so much money that was sitting in treasuries
Yeah.
that when the interest rates started to go up, those values decreased to the point where they weren't liquid enough to handle all of their, shareholders, all the people at the bank.
And that's what happened in 2022. Interest rates almost quadrupled on the 10-year treasury in just that 1 year time. And bonds saw as big of a loss as the stock market did that year. In some cases, even more so for the longer duration stuff. So it caught a lot of people off guard. And there was article after article about the 60-40 portfolio is dead. And I'm not sure I agree with that. You still need some safe stuff that's not in the stock market if that's your philosophy. But I think to the extent you can diversify that safe stuff into something that's not exposed to interest rate risk and has a lot of other advantages.
Right. It's interesting because when I started selling life insurance in June of 98, I always felt like nervous when I would talk about life insurance, and cash value insurance, because it was like compared to buy term and invest the difference. Compared to the 1990s, the stock market was just going nuts because of, you just look at what happened to computing and efficiency in business during that decade. Right. It was revolutionary, and the stock market was having its heyday. And I never really looked at it that way back then of like, well, people are comparing two apples to oranges, savings vehicles to investing vehicles, or fixed income to something that's a lot more volatile. And I recognize people just kind of collapse terms. It's just become common vernacular to say, oh, I'm saving money in a 401k. You're not actually saving money. You're investing if you're in a 401k. Right. You're not putting your money. Most people don't sit in a 401k in savings accounts or CDs, or they're typically in mutual funds.
They should be.
And most of those mutual funds are usually more on the aggressive side because, just depending on the person. But we've kind of classed these terms, saving and investing. And, if we're going to have asset allocation that says, oh, you mentioned 60-40, 60% in stocks, 40% in bonds, we're starting to talk about what are the problems with bonds and where could whole life be a solution to that, and where would it be a detriment to be in whole life. Like, I think first off, just the first few years, you're going to be behind.
That's it.
And for a while, right?
If there's one reason you don't buy whole life, it's because the sticker shock of that first couple of years is you pay a sizable premium and there's a lot less than you put in available. But usually, in a well-designed policy, by year 3 or 4, every dollar you contribute is yours plus interest. So
right.
At that point, you quickly forget about those upfront costs, and it begins to perform unlike any other asset that you can own.
Well, and think of it this way too: if you acquire that through an asset allocation decision, so you're already in fixed income like bonds, and now that same money is now going into whole life. Well, now you don't have to pay for the term insurance, and that might not be a lot now, but over time, 10, 20, 30 years, that really adds up, and that supports the whole process as well.
Yeah, absolutely. That's one of the costs long term, and eventually that term will expire. That's a minuscule fraction of people will ever collect on that, and they're very unlucky.
1.1% is what I've heard.
Yep, and they're very unlucky.
Talking to an actuary.
Yes.
Yeah, you don't want to collect on the term policy.
No, that's a very bad deal. And so most people are going to outlive that and then end up with nothing. It was good protection. I mean, minimum, if you have very low income or you need the protection and you don't have a lot of money to swing around, then sure, buy term insurance and we'll talk later. But
right, that's a good stopgap. It's good, and have convertible term insurance with a good company that's a participating mutual company, so that you have options to move to a good whole life policy, not kind of stuck with a cheap term shop that doesn't even have whole life as a conversion option.
Yeah. Well, one of the things I look at when you look at allocating assets and you think about stocks and bonds and cash and savings and whole life and all that is, there's the risk component. When people think diversification, they're always thinking about risk, diversifying, various asset classes and the risk profile. Another one is tax diversification. So if you put all your eggs in that 401k basket, guess what? It's a tax time bomb, and it's very hard to diffuse. One of the ways I like to put it is actually you're basically putting yourself in debt to the IRS, and you don't know at what rate you're going to have to pay that debt back when the money comes out. That's
strong. I always say you become a partner with the IRS, and they'll tell you what their share is based upon their circumstance in the future, not yours.
Exactly right.
That's not a partnership I'm really excited about.
No, it's not. No, it's not.
And it is important to just note, a lot of people think that that's tax savings by putting money into a 401k. It's tax deferral.
Right.
And the reason that we don't pay tax is because we don't take constructive receipt of the income.
Right.
The plan defers it. So it's now deferred income. Right. And when we go to take the income, it's now all taxable. Mm-hmm. What happens if tax rates are higher? hopefully you have more money. I think that's a weird notion where financial planners will say, you'll be in a lower tax bracket in the future. I'm like, well, first off, we have the problem with inflation. Right. Inflation pushes people into higher tax brackets because you need more money to have the same lifestyle. Mm-hmm. So if 10 years from now it takes twice as much money to have the same lifestyle, then you're going to be pushed into higher tax brackets, simply making it even more complicated. That's one issue. Mm-hmm. Second is, if you have less money in the future, how are you going to live a better lifestyle if inflation exists?
Right.
That's another concern that I have. And so why not plan for success? And so having tax diversification, so it's not all tax deferred, because I was speaking recently at an event talking about, someone's asking me about IRAs, and I was like, well, yeah, you already have one. That's not the worst thing. But if you exacerbate the problem, that's the only place that you're putting your money, and you have no other places that when taxes spike, you can pull other money out tax efficiently and let that defer for a minute, or create strategies that offset the tax on the way out. That's a strategy that requires some coordination. We might be able to get into that too.
Yeah, and I think the last piece too that people really overlook, they focus on this minutia of like taxes. I mean, even if you get the tax thing right, you're going to maybe win by a little bit. But the last piece I like to focus on is access. Is when you put money in these vehicles, you're tying that money up till 59.5. What if something comes along the way, a really good business opportunity, or what if on the other hand something really bad happens? And
right, a big emergency.
That money's tied up. I mean, you can get it, but there's some massive penalties to get that money out.
I would love to see the data. I don't know if you know the data on how many people invade their retirement plan before retirement. I know it's substantial.
There's a lot of 401k loans at least. It's a very popular, and that puts you in a tough position too.
Yeah, 401k loan, let's talk about that. There's restrictions on how much you can borrow. Mm-hmm. There's provisions on how much you have to pay and when. And you have to take after-tax dollars and put it back into a pre-tax plan.
Right.
Not my favorite loan.
It's not a good deal, but it happens everywhere.
But and I think you just make a really solid point that everyone's in store for amazing opportunities in their life. Mm-hmm. Most people cannot capitalize on amazing opportunity because they don't have liquidity. Because if the stock market's going down, and that's where someone's money is, they're less likely to say, okay, I'm going to utilize that money for this good opportunity. They're like, wait, I don't want to realize that loss, so I'm going to ride this till it comes back.
Right.
And the reality is, if you had some type of liquidity that was stable, you could get a deal and make money on the buy from day one. Distressed times, difficult times, create massive opportunity. It's Buffett always says, when everybody's greedy, be fearful. And when everybody's fearful, that's the time to be greedy. And it's like, that's because that's when there's tons of opportunity. But when everybody's greedy, there's not a lot of opportunity. Everybody's chasing the same thing. But when all of a sudden people are a little bit illiquid, and when the market starts to go down, there's so much opportunity at that point. But most people don't have access.
Yeah, I think to some of the friends I've talked to recently, and the more well-capitalized friends, and the opportunities that they were able to take advantage of in the pandemic and just right after the pandemic, properties that have now tripled in value since then. One actually just took a maximum loan from his whole life plan and put it in the stock market and rode that 40% wave right back up. So that is what it's for. And I think people overlook that accessibility at any time while still getting tax advantages and yield. That's why I think it's the best kept secret in the business.
So tax advantage, yield, going to take a minute to get to break even. Mm-hmm. Over different periods, I know you've studied this. When did bonds beat whole life, and when does whole life beat bonds, and how much, and how negligible is it? How big of a difference is it?
It's actually pretty amazing. So unlike the negative correlation of interest rates and bond prices, whole life insurance actually participates positively with interest rates going up. We haven't seen that for 50 years. We just, for the first time last year, saw the big mutuals start to increase their dividend interest rates. But I actually did a study where I deconstructed a currently available overfunded whole life policy and then mapped it against a historical data set of bonds to see which one performed better over 30-year periods of time. So kind of overfunded for 10 years, let it run, and whole life overfunded for 10 years, or funding a bond fund for 10 years and let that run. And what was interesting is every single of my 14 studies across the last century, every single one of those 14-year studies, bonds won for 10 years. For the first 10 years. And
because that first 3 or 4 years.
So even in the bad environments, bonds still beat whole life. But what was interesting to me that over the longer period of time, over 30 years, in every single one of my studies, and I'm including some investment management fees and some taxes, whole life actually won in every single scenario.
Over 30 years.
Every single scenario, because the non-volatility of whole life after that 10 years, because it can't go down, it has to go up in value, and it participates essentially in a rolling average of the long end of the yield curve.
Explain that rolling average of the long end of the yield curve.
So these big mutuals, they take in premium dollars today, billions and billions of premium dollars. They're generally investing them in long duration bonds, 10-year duration, 20-year duration bonds.
And individuals typically not either having access to that or the ability to lock money away for that long.
Exactly, yeah, because they don't need the liquidity. They can just tie the money up for as long as possible. Kind of like if you go to a bank and you buy the 10-year CD, you're locking your money up for a long period of time, but if you don't need it, that's going to pay the highest interest rate. So these companies, as almost 200-year ongoing enterprises, they don't need the liquidity. They have tens of billions of dollars of liquidity if they needed it. So they're tying it up and getting the highest yield they can. So when you think about how they perform, when they tell you they're paying 5 or 6%, even in low interest rate environments, it's because they're collecting 5 or 6% on their fixed income vehicles. And it's just rolling. Every single year they do the same investment, and some of the old stuff falls off and they replace it with new things. So over time, if you look back to the last period of time when interest rates were this low, which is the early part of the 1900s, and then it started to rise into the 50s and 60s and 70s with inflation. During that period of time, whole life insurance over a 30-year span actually outperformed, based on my numbers, about 100% to 200% better than bonds did during that period of time.
So that's what's crazy is 100% to 200% better, but now you have a death benefit that's permanent.
Exactly.
You don't have to pay for the term insurance because you have that death benefit.
Yep.
You have tax efficiency. You have access to money along the way. It's protected in over 40 states from liability and bankruptcy fully, partially in every state. So you have all these other things, but other people would say, Susie Orman or Dave Ramsey, it's expensive. The only people that benefit are the people that sell it. And these are the sentiments without looking at the numbers. Yep. And these are the same people that are going to recommend bonds as part of a diversified portfolio.
Right. Well, if you look at if you actually unpacked it, and it's very hard to do because the insurance companies, you can't see all the charges.
It's not unbundled, yeah.
But if you try to unpack it just, crudely, the fees and expenses you pay in a whole life contract actually pale in comparison to what you will pay over the course of your life on a managed investment portfolio. That financial advisor that manages that for 40, 50 years will collect a lot more fees out of that investment portfolio.
It's easy to be short-sighted.
Yep.
It's easy to look immediately and be like, hey, this is what's going on.
Right.
And there are a lot of improperly designed policies. There's a lot of companies that don't perform as well as these participating mutual companies.
Right.
So, but look, I've been doing this for 25 years. I sold insurance from 98 to 2005 or 6. And the reality is people have just gotten a lot better at designing these. There's a lot more people that understand it, that do it, because the corporations already understood this back then. The banks already understood this back then.
Sure.
But it's become a lot more common to people every day. We're seeing it because of social media. This conversation you and I are having right now. But the fact is, you saying that always loses in a 10-year period, but always won in a 30-year period with 14 different time periods, that's pretty compelling evidence.
Yeah, and the longer it goes, the better. I mean, once you get into these whole life contracts, and they're performing closer and closer to that full stated dividend interest rate. In a mature whole life policy, and I define that as 10 to 15 years old, all you're really paying for is the mortality cost, basically the difference between your cash value, that's your money, you can call the company and get it any day you want, and the death benefit that actually gets paid to your family, which could be 5 to 10 times that amount. That's what you're paying for, is basically what they're on the hook for. And that decreases over time. You're essentially replacing their risk with your own capital, which sounds bad to some people, but that's actually the magic of it. That's why it works.
I heard it was like this is the analogy I got 25 years ago. The first time I ever heard about it, they're like, it's like an airplane. It takes a lot to get lift, and there's a lot of fuel used in takeoff. Mm-hmm. But at cruising altitude, it's just getting more and more efficient.
Yeah, that's exactly right.
Right. And so that's kind of what's happening.
And to your point, there's more options today than there ever has been. There was actually some congressional changes a couple of years ago to the way these policies are designed, which makes them even more efficient, for cash generation.
Let's talk about that, because some people thought those congressional changes were negative because the minimum guarantees went down.
Yeah, it's strange. So going all the way back to the 1980s when it's called MEC, Modified Endowment Contract, but it was basically rules that put limits on how much you could overfund a whole life
because these
policy.
people in the 1980s were just putting millions of dollars into a tiny $25,000 death benefit policy to avoid taxation.
Exactly.
It was smart, but they was deemed abusive. And I think you said in 86 they changed those rules.
Yeah, it was basically not life insurance. You drop
Right.
$1 million and your death benefit's 1.2. Like, did you really insure anything?
Right.
So, what the IRS, or what Congress had the IRS come up with, was something called the 7-pay test, which is basically what is the highest amount that an insurance company, based on some assumed rate, should be able to charge for 7 years, such that those premiums will multiply into that $1 million death benefit by age 100. That's essentially actuarial school in 30 seconds. It's just discounted cash flow. How much do we need to collect for 7 years to then meet that? So what happened a couple of years ago is these companies were lobbying Congress, and at that time, the 10-year Treasury was like 1%. They're saying, look, we're making guarantees at 4%, and we're investing our dollars at 2.5 to 3.5, even in these long-term corporate bonds. Like, if this lasts forever, this is a problem for the industry, which is the cornerstone of our financial system. So they were allowed to build new policies with guarantees anywhere from 2% to 3.75. So 2% sounds worse than 4%. Oh, my guarantee just got cut in half. But what it actually did was it allowed the companies to charge a lot more money for a given death benefit. And what they're not really charging more money. They're just collecting more assets from the customer base to then put in their general investment account, assuming 2%. But they're still earning 6. They're still getting 5 and 6. So it just shifts the mix. And why this is important for the overfunding is the IRS's calculations. If you think in their mind, we need to, what's the most they can collect for 7 years to then compound it at 4% to get to $1 million? Well, if now these companies are only assuming 2% versus 4%, in the IRS's eyes, they're like, well, in some cases, we think it's reasonable that they should be able to have a premium of as much as double, what they were charging before. So from a client standpoint, that's double the contribution they can make to the plan without losing that tax advantage.
But some people talk about that as being an additional expense versus looking at additional cash value.
Yeah.
And the ability to fund more into the policy.
Yeah, paradoxically.
Without hitting that MEC limit.
Paradoxically, I've actually had someone say this to me early in my career: the more you pay for life insurance, the less it costs.
Yeah.
Which is, it took me a minute to understand what they meant by that, but basically, the more capital you put into the policy, the more interest becomes your friend, and it mitigates a lot of those long-term charges.
Yeah, I mean, it's similar to in Chapter 7 of Killing Sacred Cows. It's the self-insurance chapter, and I said the cheapest way to be insured is to buy as much catastrophic coverage as you can. Mm-hmm. Because you're transferring risk to a company for pennies on the dollar versus using your own dollars, which are at least $1 for every dollar of coverage.
Right.
And so what happens is it becomes a lot more efficient. The easy way to say it is, look, if I don't have a mortgage, I don't have to carry homeowners insurance. Right. But if I have to lock away $1 million of my dollars in case something happens to a home, just save $3,000 in premium, it's costing me more in what I could earn on that $1 million than I'm saving.
Right.
So that is a very expensive insurance to cover it myself versus $3,000 to shift the risk to a company. Yep. So, and by the way, you're getting like liability protection, not just structural protection. Right. Which is critically important. And a lot of times I get it. If we look myopically at our finances, if we think of it as life is about reducing expenses and that budgeting is the way to wealth, which it's not, because you don't shrink your way to wealth. But if that's the frame that we're in, reducing expenses is what a lot of people are trying to do. But if you look at your insurance premium as an expense without looking at what the cash value is doing, then you're going to get caught in that trap of you should definitely buy term insurance because it's a lower premium. But you and I know if someone lives a life expectancy and pays the premium for term, it will be more than the death benefit. Right. Because they will be phased out when it's actually potentially going to claim. So it's again, it's looking at the big picture versus the just the surface level. It's understanding the opportunity cost. It's understanding what's going on. If you're in a bond and the interest rates change, you have fluctuations in your value. If it's in cash value, once a dividend's paid, it becomes your guarantee. And moving forward, you have that minimum guaranteed interest rate, of which companies that you have policies with and I have policies with for over 100 years have always paid more than the minimum. Now, could they go to the minimum? Absolutely. That's why it's in there. Yeah. There's economic conditions that would have that happen. But what I do know is the banks have been in trouble many times since I've been in this business. Mm-hmm. In 2000, 2001, 2002, there were some issues. 2008, major issues. 2020, major issues that showed up in 2022. And some of the bank failures. Guess what? No participating mutual life insurance companies even had a blip. No. Even made the news. Even had an issue.
Right.
Because they're not operating the same way that these banks are operating.
Yeah, and these companies were founded in the 1850s, and we're talking about starting to pay dividends in Civil War times. They've been around a long time. They've seen a lot, and honestly, the business model is not all that different than back then. They're still selling policies that kind of look similar to what was issued back then. It's a very stable. The reason they're all so highly rated is because they're just sitting on war chests of capital that's very diversified, very conservatively invested. You can't kill these companies. And that's why they all.
If you can, we're in trouble with everything at that point, right?
They're going to be the last ones to go. Exactly right. So
one provision that I think, if we're going to point out the negatives, if we're going to say here's the things to be aware of, and I don't know if this is with every company, but I think it is, the provision that says they can take up to 6 months to give you your money.
Mm-hmm.
Is that in every contract?
I don't know if that's in every contract. I think different companies handle that differently.
Because I've read it in contracts I have.
Mm-hmm. Yeah, I mean, I don't think the big mutuals operate that way. They,
right.
I've heard that claim checks will come pretty quick, but technically speaking, that I think they do actually have that ability.
I remember when 9/11 happened, some of the mutuals just set up tables, mm-hmm. and circumvented a lot of the claims process to get these families money immediately.
Yeah. They're so well capitalized. I mean, that's not a problem for them. Yeah.
But also, like, this is, what if I go to borrow my money and they go, all right, we can have up to 6 months or 3 months. It's just something to be aware of. It's never happened, but it's kind of like no one was ever denied money on the reciprocal desk. And when they denied Bear Stearns and Lehman Brothers money and then shorted their stock, they went under. And it's never happened in 100 years. So it's just something to be aware of. Maybe, I always look at anything that's in a contract is in there because it could happen.
Right.
And can I live with that?
Right. Well, I think what you just said a minute ago is really astute. I look at people say, I don't need permanent death benefit. But the whole crux behind buy term and invest the difference is you're going to own term insurance while you have no money, and then you're going to save money and invest. And by the time the term is over 20, 30 years down the road, you've built up your millions. So now you don't need insurance.
And yet that's the people that when I have millions is when I want the most.
Those are the ones that do the best with permanent life insurance. I'm going to your point a minute ago is, my book called, Permission to Spend is all about
the book.
It's all about the fact that people get to retirement, even if they're successful and have a 7-figure net worth, they still get to retirement and they're terrified to spend because of all the things. One of them is they want to leave a legacy to their family. At the least, they're obligated to leave their spouse something, but they may have children or charitable interests they want to leave a legacy to. They're terrified of ongoing medical expenses that aren't covered by traditional medical plans like long-term care. They want liquidity, just some place to tap into assets just in case for all the things they can't think about what might happen. And they're essentially showing up at retirement, even if they've got a couple $1 million invested, acting like their own insurance company, hoarding wealth just in case very unlikely events occur. Whereas they could shift that, with a permanent death benefit, I can guarantee that legacy to my kids. I can guarantee my spouse is taken care of. I can provide a pool of funds that doesn't have RMDs and 59.5 rules and all the things that come with IRAs. No taxation, guaranteed to go up in value every year. So for me, and that's kind of the idea behind the book, is when you install this backstop and you install that future wealth into your plan, you give yourself greater freedom to spend. We were talking about on the ride over here this morning. It's almost like if you have a trust fund that pays out in 20 years and it's going to be a 7-figure sum, how differently do you operate and spend
for the next
money?
20 years? Yeah.
For the next 20 years, you are spending a lot more freely. You're taking a lot greater risks. You may be invested in a way that you otherwise would feel uncomfortable, which historically has done very well for folks. And that's what you can install into your retirement plan. And that's why permanent death benefit is so important.
Here's when I think people should fire their financial advisor. If they say you should buy term invested difference because when you have enough assets, then you won't need the insurance. Because what's going to happen is they're going to go talk to an attorney, and the attorney's going to say, hey, guess what? You've been really successful. Now you're in your 60s or 70s. You don't have any insurance, and you're going to have this estate tax, so we should go buy some insurance.
Mm-hmm.
So you could have had it basically 14 out of 14 times better off in more cash in your fixed income portfolio and whole life than you would have been in bonds, and have this death benefit there for you in the future.
Yep.
Or not have it, and then you'll have to go buy a death benefit when it's probably harder to get the best ratings and when the premiums are going to be a lot higher because you have a shorter lifespan at that point. I mean, that feels like malpractice. That's so frustrating to me. It's like if you have a client that's going to be successful, why would you give them advice for poverty?
Yeah.
It doesn't make sense.
It's just a lack of understanding, honestly. It's complex for a lot of the advisors. It doesn't fit the asset allocation models. Honestly, the planning software available to financial advisors typically doesn't allow you to show a life insurance contract as part of an asset allocation. It needs to be dealt with separately. So it's hard for a lot of even advisors to get their mind around where it fits in the bigger.
It's so much more work for an advisor to sell an insurance policy than to put someone in bonds.
Mm-hmm.
There's underwriting processes.
Yeah.
There's illustrations. There's
there's two
delivery requirements. There's just a process that goes along with that. The person has to go get urine and potentially blood. There's just extra steps.
Yeah, and it's uncomfortable, and in their mind it can jeopardize the client conversation. I always say there's two major hurdles to owning a good permanent participating whole life policy, and the first one is underwriting. You got to prove that you're healthy enough to get it, and then go through that month-long process, or even longer in some cases. But assuming that you are in great health, the second one is patience. It's going to take several years for you to write that check and feel really good about it, and watch your cash values start to go up more than you're paying in. But I've never, in my entire 21-year career working with thousands of advisors all over the country, had one person tell me that they had a client who owned it for 20 years and said, man, that was a bad deal. That was a bad idea. They're usually asking how they put more money in once they get are too unhealthy to do more.
Right. Then now they've seen that it works. So
right.
All right. So there you have it. Bond portfolio fixed income versus using whole life as an asset allocation decision. 14 different years where it was 30 years, it always won. At 10 years, it always lost. So as a medium-term to long-term strategy versus a short-term strategy, extraordinarily useful.